Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are going to be working on the Chapter 4 short exercises. And as always, when doing these exercises, remember this is the application part. If you don't understand the concepts and the theory part of it, then you're not going to be able to do the application. If you're watching the video, and the issue is with application, well, and watching me working through the problem, you'll understand how to do the application. But if you don't understand the theory or the concepts, then you're not going to be able to do the application. So if you don't understand the theory, go back and watch the theory videos. Of course, go back into your textbook. Remember, your textbook is your primary reference, and restudy the theory videos. And also warn you that this is accounting is a cumulative type of thing, meaning, just because if you don't understand a concept, you're not, you may not remember that or understand that concept from one of the previous chapters. And therefore, if you can't get a problem because you don't understand the concept, don't think it's just in chapter 4 that you'll be able to find that concept. No, it may be from one of the previous chapters that you don't remember or have down, that particular theory or concept. So, go back and don't think it's just in this chapter. I mean, remember, this is not American history, where each chapter, you study the American Revolution and you can forget about it when you go to the War of 1812. And then you study the War of 1812 and you can forget about it when you go to the Civil War. It's not American history. Things that happen in chapter 4 are based upon chapters 1, 2, and 3. All right, so uh, go back and make sure that you fill in the gaps in your thinking, as far as theory is concerned. And if you still have any problems, feel free to contact an instructor, and we'll guide you, especially when you get further into the subject. Because let's face it, if you're in chapter 17 and you're missing something from, say, chapter 3 or chapter 4, it's kind of hard for you to find that information. So feel free to contact an instructor if you don't understand something. So with that, let's get moving here with the short exercises. Okay, so let's get my pen. All right. It says here, adjusting inventory based upon physical count. Right. So Kohl's Furniture uses the perpetual inventory method. At the end of the year, Kohl's Furniture inventory had a ledger balance of 163,000. A physical inventory count revealed that the actual inventory on hand totaled 161,800. Journalize the transaction necessary to adjust the inventory account at the end of the year. Okay, now whether this was perpetual or periodic, you both are going to be done the same way. Just because it says perpetual, what this means is that the beginning inventory was 163,000, and then somewhere along the way, the difference between what the beginning and the end, so 161,800, means that the difference between the two is $1,200. So basically what happened is the book started with 163, but somewhere along the way, a transaction or transactions occurred and the entries weren't made. Remember, with a perpetual inventory method, every time something goes into inventory or something comes out of inventory, you need to make the journal entry. So basically what they're saying here is they didn't make the journal entries. And now when they get to the end here and they see that the actual inventory is 161,800, well, it's like, how come? So an adjustment has to be made for the 1,200. So of course, with periodic, you start out with the 163, and then it doesn't matter what goes in and what goes out, because your books are always going to be reflecting, what comes in, generally what comes in, not necessarily what goes out. And at the end of the period, you end up with 161,800, right? So you end up making the adjusting entry for the 1,200, and that adjusting entry, obviously, the 163,000 is an inventory, and inventory is an asset, and our assets are increased on the debit side, right? The normal balance of an asset is a debit. So our inventory account had a debit of 163,000. Well, it's decreasing by 12,000, so obviously we have to credit inventory for the 1,200. And since debits have to equal credits, we have to debit something else. And what are we going to debit? Well, we're taking it out of inventory. And when we take it out of inventory, we put it to cost of goods sold. So that's our journal entry, right? And that's this problem. 4-3, generalized inventory purchases. Suppose A1 Sports purchases 83,000 of sportswear on account on December 1st. Credit terms are 210, net 45, and A1 Sports pays outdoor wear on December 8th, so that's 7 days. So it's falling within this 2% 10 period. 2% net 2% 10 period, right? And it says journalize the transactions for A1 Sports on December 1st and December 8th. And then it's what was the final cost of the inventory for A1 Sports. Okay, so on the journal entry, the date is 12/1, and we're purchasing 83,000 of sportswear on account. All right, so this is the entry on December 1st. Well, making a journal entry, ask myself, am I affecting cash? And the answer to this question is no, because I'm not paying the 83,000. So I ask myself the next question, am I affecting accounts payable or accounts receivable? And the answer to that is yes, because it's on account. So if it's on account, I know that accounts payable is liability, and I increased the liabilities on the credit side. So I'm going to credit accounts payable for 83,000. And if my debits have to equal my credits, I'm going to debit something else. And of course, I'm buying inventory, so I'm going to put it to the inventory account for 83,000. Right, so that's that entry. Now, it says credit terms are 2% 10. Let me erase some of this here. It says credit terms are 2% 10, and we're paying off the bill on December 8th, so that's only 7 days away. All right. So I'm able to take a 2% discount. So 83,000 times 2% gives me, let's see here, $1,660. That's going to be my discount. Okay. Now, my journal entry. So 12/8. All right. I'm paying the I'm paying off the inventory, right? Well, I'm sorry, I'm paying off my accounts payable, right? So it says here, credit terms are 2% pays outdoor wear on December 8th. So I'm paying off my accounts payable. Well, if I'm paying off my accounts payable, that means I have to debit my accounts payable for the 83,000. Right? Now, if my debits have to equal credits, I have to, credit something else. Well, obviously, I'm paying cash, right? And if I had 83,000 and I have a discount of 1,660, that means I'm going to pay $81,340 in cash. So I'm going to credit my cash for $81,340. Now, obviously, my debits still don't equal my credits here, so I have to credit something else. Well, what am I going to credit? Well, if my inventory, I had put 83,000 in inventory, but I'm only, after I had a discount, I'm lowering my inventory, right, by $1,660. Well, that means I have to credit my inventory $1,660, right? So that my net inventory is $81,340. On a T account, if this was my inventory account, I would have had a debit of $83,000, right? I'm paying for inventory the total amount of 81,340, so I have to credit 1660, which gives me that net effect, oops, of 81,340, right? Yeah, I originally thought I was buying it at 83,000, so I booked it at 83,000, but the final amount that I paid for it was this 81,340, so I have to adjust it to that amount, all right? So that's 4-3, 4.3, right? And I'm at 10 minutes, so I'm going to stop here and pick up in the next video with the next problem.